The wheel strategy, super popular, right? Everyone on Theta Gang trades it. People who love selling options trade it. People who are sick of losing money on options have crawled over to Theta Gang and learned how to trade the wheel strategy. Why? Well, number one, it's fun. It's just fun. Do I have to explain it? It's fun. It's also a good way to diversify your portfolio strategies. It helps stabilize a portfolio. It'll outperform the underlying you're trading it on if the underlying's trading sideways or during downturns. Now, generally speaking, it actually won't outperform the underlying if you chose a good one when it uptrends. But that's okay because sometimes you want to diversify your portfolio in unique ways just to provide more stability. Just like anyone investing into bonds or investing into dividend stocks, they're just trying to provide diversity and stability to a portfolio. Not to mention, if you take all the premiums and capital gains you get from running the wheel strategy and then throw it into some leaps, you might be able to outperform the underlying by a substantial amount. So just because the wheel strategy itself doesn't outperform consistently doesn't mean you can't outperform it if you take those returns and throw it into something that's leveraged like leaps. That said, it's just a fun strategy and everything, but there are a few misconceptions that are causing people to leave money on the table that I want to address that I did not address in the wheel strategy tutorial. The first one being, if you're trading the wheel strategy in an individual brokerage account, great, totally fine, because you're making money, right? It's better than not making money. It's better than just saving your money if you are trading it correctly and trading on a good underlying stock. However, you're going to be fleeced by short-term capital gains because all your premiums are going to be taxed as short-term capital gains, and all your capital gains from selling a cash secured put being assigned here and then selling a covered call and being assigned here, those capital gains, the difference between the two, is going to be taxed as short-term capital gains tax because they're not that stock position is, if you're trading it normally, not going to be held for longer than a year. So you're going to get fleeced by taxes. So something you might consider if you haven't already is trading the wheel strategy in a tax-protected account like a Roth IRA. A Roth IRA allows you to trade like crazy, completely tax-free, if you withdraw your earnings when you're 59 and 1.5 years of age. So if you're trading and investing for your retirement way out in the future, which you should be doing anyway, unless you plan to retire early, it's a great opportunity to trade the wheel completely tax-free and not have to pay those really high short-term capital gains taxes. That said, there are contribution limits yearly. 2022 is about $6,000, and there's an income limit that's somewhere around $125,000, although you'd have to look it up. And so if you're over $125,000, don't even worry about it. You can just use the wheel strategy in your portfolio if you want to diversify, but you are going to be paying those short-term capital gains taxes, which blows big old chunks. So yeah, consider it. If you have like, $5,000, $6,000 in your Robinhood account or whatever, and you don't have a Roth, think about putting it into a Roth because yes, you can only withdraw the earnings when you're 59 and a half tax-free, but think about how much money you're going to be adding all across those decades and the amount of money you're going to be saving on taxes by the time you withdraw from there. So you can add to your Roth and add to your individual brokerage. So if you want to retire early or whatever, maybe you can do that using your individual brokerage account. And then when you hit 59 and 1.5, you can really go ham and get a bunch of coke and hookers on a yacht. You know what I'm saying? So I'm just trying to look out for you here. So it's a great option, something to consider if you want to avoid paying those short-term capital gains taxes and also make it easier to track your adjusted cost basis without having to do some weird, like go call your accountant and figure out how to enter that into the spreadsheet. It's just a big fat headache. Okay, so that's number one. Number two I want to talk about is the adjusted cost basis, which I talked about in detail in the wheel strategy tutorial video that I mentioned earlier, and you can find in the description below. The adjusted cost basis just tells you where you can sell your covered call, excluding the covered call's premium, and if you get assigned that covered call, you'll end one full cycle of the wheel with a profit. Selling cash secured put, roll and avoid assignment, get assigned that put, sell a covered call, roll and avoid assignment, get assigned that covered call, and as long as you sell that covered call above your adjusted cost basis, you're going to end that full revolution of the wheel with a profit. However, that's not necessarily looking at the bigger picture of things. And to kind of drill this into your head, why just the cost basis isn't the golden number you should be looking at, I have an example here in a spreadsheet. Okay, here's an example on Amazon. We've been selling a bunch of puts and rolling them like crazy. We haven't sold any calls yet, right? So here initially we opened a put. We rolled that put to a 150 strike with a further out expiration. And then we bought to close that put at a 50% profit, opened a new put, and then we rolled that final put out in expiration just to collect a little bit more premium as the stock price blew below our strike, just to give it a little bit more time to pop back up above the strike of our put. Okay, so with this example, you can see that we've collected $653 of total credit so far just by selling and rolling puts. Okay, so that's $653 we've had come in through the door. Now let's say we get assigned one of our puts. And when we get assigned a put, we are paying for those shares. So you can see the strike of our put is 160. We have to pay $160 per share for 100 shares when we get assigned. So that's going to be on the debit side of things, where money's going out the door. So we're going to say assigned stock or something of that nature. We'll put today's date, 9/15/20. And when we are assigned a cashier put, we buy 100 shares at the share price, at the strike price, which is 160. So we'll enter the share price here of 160. Hit enter, and we pay a total of $16,000 for these shares. And now we can look over and we can see where our adjusted cost basis is. The cost of the shares, which is $160 per share, minus all the premiums we collected, which is, if I hit Control Z, $6.53 of premium. That's going to give us an adjusted cost basis of $153.47. And all that number means is if you get assigned above $153.47 with your covered call, you are going to end with a profit, excluding premium. That premium you sell from the covered call is going to obviously contribute to that profit. But excluding the premium, if you sell a covered call with a strike anywhere above that adjusted cost basis, you're going to end one full revolution of the wheel. Okay, and to show an example of that, let's go ahead and sell a covered call here. We'll say just above our cost basis, our cost basis is 153, we'll sell a 154 covered call. So 154 call onto whatever date, doesn't matter. It's going to be for 100 shares. So if we get assigned, we're going to sell 100 shares. And we're going to put 0 just for the credit, just to make it simple to show you that when you sell above your adjusted cost basis, you're going to end with a profit. Obviously, whatever credit you get from the covered call is going to contribute to that profit. But just to keep it simple, we're going to put 0 for that credit. And total money received is going to be 0. Now let's say we get assigned. That means we sell all those shares. So it's still going to be on the credit side of things. So it'll be, let's say, stock is called away. So the stock is called away. It's going to be 100 shares that are called away at the strike price of 154. Now if we go over, we see we made $53. We've gone through one full cycle of the wheel, and we've made only $53, which is kind of confusing because you look at all these credits we received. $290, 505, 500, 708. And I know we paid some debits, but really we did all of that just to end with $53 profit? What happened? Well, it's because we only sold our covered call 53 cents above our above our adjusted cost basis. So if you look at our adjusted cost basis again, it's 153.47. Well, if we sold with a strike of 154, that's going to be 53 cents above our adjusted cost basis. So our profit is going to be 53 cents in premium, which is going to be $53. So my main point is whatever you sell above your adjusted cost basis is the profit you're going to get, no matter how many premiums you've collected so far. So the adjusted cost basis isn't exactly the best place to look to maximize profit because you're actually eating into your premiums. If you think about it, we've collected all these premiums from selling and rolling, etc. But when we were assigned the stock, when you bought at $160 per share, and now we sold at $154 per share, the difference between where we bought and where we sold is $6 per share. So we lost $6 per share on 100 shares, which is $600. So we have actually taken all our premiums and then subtracted $600 from that because we sold our stock at a lower price than we bought it at. We have a capital loss for that stock position, which is eaten into our premiums by $600 and left us with $53 left over. So when you look at the adjusted cost basis, yes, if you sell your covered call above it, you're going to make money. We did make money, $53, but it's not a lot. If you want to maximize your ability to make money when trading the wheel, you want to sell above your actual cost of the stock, which is $160, right? Because then if you if you think about it, if you buy it at $160, you want to sell above $160 so you make that capital gains and keep all the premiums that you sold so far. So let's do that as an example. Let's say instead of the 154 call we sold a 161 call, okay, just above the actual cost of the stock that we purchased when our put was assigned. So down here we change. When our covered call was assigned, we changed the share price to the strike price of 161. We're selling all those shares at the strike price of 161. And now look at our profit. It's $753, right? Because that means we kept all the premiums we've sold so far. We've kept all of them, all of these credits, of course, minus the debits we paid when we're rolling. But we kept all of these credits minus the debits, and we get to keep the profit from buying the shares at 160 and selling them at 161. So that way we keep all the premiums plus the capital gains from being assigned a cashier put down here and then assigned a covered call up here. So if you want to maximize your profit, yes, always sell your covered call if you can above the actual cost of the stock that you were assigned on your cash secured put. That'll maximize your profit, and you won't be eating into the premiums you've collected by selling all those cash secured puts and all those covered calls. You won't be eating into that premium. So if at all possible, yes, sell above where you were assigned your cash secured put so you can make some capital gains. Now that won't always be possible. It might not be worth it for the premium you're getting. And so the adjusted cost basis kind of gives you the psychological comfort to sell covered calls below the actual cost of the stock as the stock is heading downwards, because you know if it pops up all of a sudden, you are going to end with an overall profit. But meanwhile, you are collecting credits because you have the confidence to sell those covered calls below the actual cost of your stock, but above your adjusted cost basis. It just gives you psychological comfort during a downturn to be selling and collecting more premium. Now, sometimes this will pay off, and as the stock moves up, you can roll those covered calls up and eventually above the actual cost of the stock where you were assigned, and you'll be able to make capital gains when you were assigned your covered call. Sometimes it won't pay off, and you'll be assigned below the actual cost of the stock of 160, for example, but above your adjusted cost basis, and you'll still end with a profit. You're just kind of eating away at some of the premiums you're making. So in short, I know it's kind of confusing. If you sell above your adjusted cost basis, great, you're going to end with a profit, but you are going to be eating into the premiums you sold if you are assigned your covered call below the actual cost of the stock in this example, which is 160. You buy shares at one price and then you sell at a higher price, you're making more money. You buy shares at one price and sell them at a lower price, and enter, you're going to be making less money, right? Because you're just not making capital gains on the stock position. Okay, I'm kind of going in circles here. So just view the adjusted cost basis as like a helpful place to know where above you can sell your covered calls to make a profit. But if you're trying to make as much money as possible, not eat into your premiums, and you can, if the stock isn't dropped, sell above the actual cost of the shares where you were assigned your cash secured put. Okay, that was point number 2, and probably the goddamn longest point I've ever made. Hopefully that makes sense. The last point I want to make is usually people set a take profit limit order at 50% of the cash secured put or covered call they sold. So if they sold a cash secured put for $100, you might set a take profit limit order at 50 cents. The first 50 cents will decay quite quickly, and it'll take quite a bit more time to get the last 50% of that option. So taking profit at 50% is a good place to set it at, and is generally where most people set it at. It's kind of popular. But you shouldn't do that when you roll your position. So for example, if I look here, I initially sold a cash secured put for $2.90. I would set a take profit limit order at $1.45. So once this option has decayed in value through theta or lost value through delta, I will buy to close it at $1.45, making a $145 profit. In this example, that did not happen. The stock went against us. It went down, and I had to roll to avoid assignment. So I rolled, paying a debit of $4.95. Going to a little bit of a lower strike, so it's less likely I'll get assigned for an overall credit, right? So I paid $4.95, but then I sold the new one for $5.05. I'm having more money coming in the door in case I do get assigned. So I'm rolling for an overall credit. So if I set a take profit limit order at 50% of this option, I'd set it around $2.50. And let's say that happens, the stock goes up, the price of the put goes down to $2.50, and you buy to close it right here for $2.50 in premium. If you look at your adjusted cost basis or running profit and loss, in this case it's your running profit and loss, we've only made $50, which is kind of confusing because we sold this guy for $2.90, we sold this guy for $5.05. How the hell did we end this with $50 in profit so far? Well, it's because you paid a big fat debit to roll. Yeah, you sold this for $2.90, but then you paid $4.95 to roll it out to $5.05, which is only $10 more. So in other words, I could just delete this $4.95 and put 10 cents right here to help make the picture a little bit more clear. I rolled it for 10 cents total. We have $2.90 in plus 10, that's $300 in, and then we paid $2.50 to close it. That leaves us with a running profit and loss of $50. That sucks. You kind of goofed there. What you want to do instead is don't set a new take profit limit order of 50% for the new option that you rolled to. Set a take profit limit order for the option that you originally had open, which is this $2.90 put option. So if you open this $2.90 put option and we set a take profit limit order at $1.45, and it doesn't hit it and we have to roll it like we did in this example, and we rolled it out, down and out to an expiration of 10/21 at a 150 strike for an overall credit, and we sold the new one for $5.05. We now want to set the take profit limit order not for $2.50, which is half of $5.05 roughly, but for the half of the original put that we opened, which would be $1.45. So in this example, if we bought the close it at 145, then we'd be making $155. So we want to let it decay down past below where you originally opened your first put. So that way you make the most money possible. Otherwise, you're kind of wasting a lot of time. That's just personally how I do it. Otherwise, you're going to set your take profit limit order at 50 cents or 50%, and you might end up not making a whole lot of profit. Instead, just let this option decay as much as possible. And of course, roll and avoid assignment. But when you're setting your take profit limit orders, do it based on the initial put you opened, not the one you rolled it to. Okay, so to kind of summarize here, I know this stuff is really heady. It's making my brain fry out. But to kind of summarize here, if you're not trading in a Roth or a tax-protected account, consider it. It's not necessary to make money, obviously, but it's a good way to trade the wheel efficiently. Number two, yes, adjusted cost basis is important, but it is just kind of mental gymnastics to show you where you can end overall with a profit. But you can also look at it separately. You can just look at all the premiums you've taken in so far, and then look at the difference between where you were assigned your put and where you were assigned your call. And if your call is above where you were assigned your put, that's capital gains. If it's below where you were assigned your put, that's capital losses. So if you have capital losses, if you're assigned below the actual cost of your shares where you were assigned your cash secured put, that's going to eat into the premiums you sold. So if at all possible, obviously, sell above the actual cost of the stock where you were assigned on your cash secured put. That'll allow you to keep all the premiums you've collected, as well as get some extra capital gains on top of that. That's the best way to win. That's the best way to make the most money possible. And it's usually possible to do that unless the stock is tanked and it's becoming difficult to sell covered calls above the actual cost of the stock for any sort of decent amount of premium. And in that case, the adjusted cost basis tells you, hey, it's okay to keep selling covered calls down here. It's a little risky because you could get assigned down here and it'll eat into your premiums. But if you don't get assigned down there, you can continue to collect premiums. And as the stock recovers, you can move your covered call up and up and up above your above the actual cost of the stock and start making some capital gains in case you are assigned. So it gives you that psychological comfort that, hey, I can actually sell covered calls if the stock keeps tanking. I don't have to sell it above the actual cost of the shares, but best case scenario, you would do that. But you don't have to, obviously, to end with a profit. Now, to avoid me going in circles, I'm going to shut up right now. I love each and every one of you in a special and unique way. If you want to make some extra money, there's a Webull link down below. Deposit $100, you'll get some free stocks, and so will I. It's a win-win. Love you guys to death. Hope you're having fun out there in this very tumultuous market. Is that a word? I think it is. All right, I'm done. Peace out. Love you.